I'm David Faber. At Liberty Media's annual Investor Day, we have a chance here to sit down with the company's chairman, John Malone. You heard my interview just now with Liberty's CEO, Greg Maffei, in which we were discussing the proliferation of content, the enormous amounts that are being spent by companies such as Netflix, Disney, Amazon, and Warner to amass content for their direct-to-consumer platforms. Maffei says it may have years to go in terms of these inflated prices. I did ask Mr. Malone as well when he thinks things will start to rationalize.
I think that the number of people trying to do scripted programming on a global basis and buying this content away from each other will thin out as some people make it and some don't. At some point, some of the players are going to look at the numbers and they're going to say, you know, we no longer have belief that that Hail Mary passes are going to keep working. Reed, you know, who's been brilliant.
Reed Hastings.
Yeah. He's been throwing Hail Mary passes since he started, right? And it's worked for him. And now he has a budget that's huge, bigger than anybody else's. Over time, he'll have to turn the dials to modulate that spend to where he has a really good business that doesn't churn out on him. People will start experimenting with bundling with other services to reduce churn, to make it more sticky. Distributors will start bundling on behalf of some of these people if in fact that reduces churn and makes the composite more desirable, more sticky.
Right.
And so it'll evolve the same way that the cable business did and the big bundle was created, right? And as those new packages are created, the guys who have uniqueness will start extracting more and more share. The prices will go up, and we'll see this play again.
Yeah, exactly.
Right?
Well, I mean, you know, I'm not mentioning it for our viewers,
Yeah.
of course, to understand. You're not just talking about this idly. You obviously own a significant stake in Charter, so you see it from the distribution side. Significant stake in Discovery, so you see it from the content side.
Internationally, we see it.
And internationally with Liberty Global as well. When you think about cord cutting right now,
right.
You know, everybody's like, oh my God, it's just going to continue at this rate. We've watched the losses at Direct and at Dish in particular.
Right.
Does it start to level off at some point?
Yes, I think it does. It doesn't stop, the erosion doesn't stop completely, but it'll make a transition to where, in my opinion, these distributors will start becoming where you go for a bundle of other services. So you may not buy the big bundle, but you might end up buying a service from HBO or Netflix. Or Netflix already is distributed by most cable operators, right? As an incremental service. Certainly Prime is talking to the distributors about a similar relationship. My guess is Disney will eventually, you know, be willing to provide some split in order to be in a bundle if that reduces churn or helps distribution. Discovery will be in that situation over time. So, you know, this will be a transition. It won't be a black and white thing. Right at the moment, because the video margins for the U.S. cable distributors are thin and getting thinner as more and more retrans pressure and, you know, sports pricing pressure comes in, it's been sort of discovered that actually margins improve as you lose video customers and you become less capital intensive. And so if you shrink the video base and don't try and innovate the video platform, right, your margins go up, your CapEx goes down, your levered free cash flow goes up, and your stock takes off.
What about these companies? I mean, does Discovery have enough scale? Does CBS Viacom have enough scale? Do we need to see one more round of sort of consolidation among content providers?
Well, I mean, if you go back a couple years, you know, Discovery is the one I'm most familiar with.
Of course.
Right? 32 years, I think, now. But we saw in Scripps, for instance, a consolidation opportunity that would give us scale, increase optionality, brands that we understood, talent in the organization, opportunity for synergies of consolidation. Didn't solve the direct consumer issue, but gave us a lot more firepower. So that's worked out really well. And now Discovery is, got an investment grade balance sheet, deleveraged quickly, generating, give or take, $3 billion a year in levered-free after-tax cash, right? So they got a lot of juice with which to solve their issues. They own all their content worldwide in all platforms. And they're pretty much the only global company right at the moment whose products are in front of audiences on a global basis. So they've got a lot of the pieces, right? They need to make the transition from linear to interactive IP direct consumer.
Which is what we were talking about.
Correct, that's correct. They need to...
The hybrid approach.
They need that hybrid approach, and they're reaching out in a lot of different ways. They brought in some extremely highly talented people from ex-Amazon guys to help them with this direct consumer opportunity. And I personally am willing to bet that they're going to make this transition.
Well, you bet a little more even earlier this week.
I did.
Well, actually, it was a pretty big purchase for you. What, 2.6 million shares?
$75 million bucks. I wrote the check, yeah.
Why'd you do it now?
I believe that they will solve these issues and that they are dramatically undervalued right now. When I put my screen up and I look at companies based upon market cap versus levered free cash flow, they were the cheapest thing on the screen. And I said, wait a minute, they're growing in a world where everybody else is shrinking. They own all their content. They're generating a ton of cash. They're an investment grade balance sheet. Why are they cheap? And
what is the multiple on free cash? It's really low, right? Low
6 times, probably 5.5 times cash. So, so that's given them like 16, 17% cash return, right, after tax. So that's pretty darn cheap for a good company. So I said, yeah, I think I'll buy some more. I started buying it when the Scripps deal got a thumbs down from the market. So I bought some in the teens. Then I bought some more in the very low 20s. And now I'm buying some. I think I paid $28.03 for the shares that I bought. So I've increased my exposure to Discovery. And I did it because I believe I'm going to make money.
Lionsgate.
Right.
Why did you sell it?
I sold it because I didn't see them execute a strategy of using their library and content capabilities to drive Stars. I really thought the opportunity was to take Stars, use Lionsgate's creative skills to drive Stars globally, aggressively. And they got, in my opinion, they got hung up on selling our content to somebody else versus putting on our own distribution. My concept originally when I went into it was that they were going to drive their own distribution. I also thought that if they were successful in that, they would make themselves much more valuable to other people. Okay? And I think that they didn't do that, and I became discouraged with their ability to do that. Now they seem to be gaining some traction now outside the U.S. in distribution. And they've gained some traction in the U.S. with Amazon as a marketer for Stars. It was just, it was the question you started with.
Right.
Who's going to win in the streaming game? And I didn't see a path for that company to be a winner in that space. If they didn't merge with somebody else.
They were close to, CBS before the Viacom deal was pretty close to.
And maybe still. Yeah. Maybe still Showtime and Stars should get together because there's enormous synergy in that combination, and that would provide scale.
Right.
But this is a scale game, and you've got to be global to get scale.
You know where he's coming from. He's always talked about it. Global scale, so important to this business model.